Hi there, my name is David Andolfatto. I'm with the Federal Reserve Bank of St. Louis Research Division. I'm here at the 40th Annual Fall Policy Conference. And I'm here with Ed Prescott of Arizona State University. Ed just gave a plenary talk entitled "The Monetary Policy with 100% Fractional Reserve Banking and Exploration." And Ed's been kind enough to sit down here to talk with me and us, I guess, to tell us a little bit about this research project, which I have to confess I'm a little surprised to see you get into issues monetary, given your reputation to kind of abstract from matters financial and monetary. You've very much focused on kind of what we might call real factors. Tell me, what motivated this line of research? What is it about here?
Over the years, I've done a few things in the monetary area. It's an interesting and difficult area. Mm-hmm. In what motivated this, people were asking questions. I didn't have the slightest idea, and I didn't seem that anybody else had a good answer to it. And I felt there was a need for more investigation of this in a serious way that sort of matches in close with the real. The way they do it in the real. National accounts are important, and balance sheets. The way they report the data in money's different. And some facts come up, and I wonder why.
So I guess a lot of people have been asking questions, I presume, especially since the financial crisis we've just lived through. I presume that that's what's been motivating these questions that you didn't have good answers for.
Well, you see so much in the paper about, in the news, about should we increase the interest rate, or should we do have an inflation rate target? In the answers that people, justifications, are not based upon strong theory.
The monetary crowd would have called this a form of narrow banking, where the demandable liabilities issued by financial institutions would have to be backed 100% with some form of cash. It's kind of an old idea. A very old idea, I guess, and people have largely promoted it to as a remedy to prevent what they perceive to be bank run phenomena. Is this what are you doing here that's kind of complementary to or different from kind of what people have done so far?
Well, at the beginning you mentioned real economist. Mm-hmm. Everybody says or thinks, or not everybody, but that there was problems in the financial system that gave rise to the Great Depression. Mm-hmm. We've looked at that in systematic way using modern theory. And we found that businesses had all kinds of money to invest, and they didn't. They gave it to the owners, distributed to the owners. It's because businesses did not perceive they had profitable investment opportunities. And so the people, I don't think financial crises are a big deal. Tom Sargent, who's a great of the modern macroeconomists, along with Robert Lucas, examined the entire 19th century, all the financial crises in that period, and how there's periods when there wasn't even any central bank. Andrew Jackson, who was an independent sort in the 1830s. During that century, the U.S. economy grew at a healthy rate. In spite of repeated financial crises, it became the richest or biggest industrial economy in the world in terms of highest living standards, and also biggest.
Mm-hmm. So, but I mean, let's take a look at that history. I mean, I'm thinking of economic historians like Gary Gorton in particular has pointed out the U.S. national banking era from about 1863 to 1913, the founding of the Fed. And indeed, that was an era of great prosperity for the United States in general, so we know that. Also, generally a deflationary episode as well. We know that as well. Nevertheless, I mean, that era was punctuated by several rather severe business cycle episodes. And many of them were associated with financial crisis, banking panics, and what people have labeled bank runs. And even though there was no lender of last resort or Federal Deposit Insurance Corporation, no central bank, as Gary has pointed out and others, there were nevertheless what you might call central bank-like interventions, in the sense that prominent bankers like J.P. Morgan would coalesce the banking sector, suspend redemptions, issue clearinghouse certificates, and essentially operated what looked like private sector lender of last resort operations. So, I mean, these episodes were associated with disruptions in payments and a large loss in output. And there was a general perception that, rather than relying on the private sector to serve in this role, that we might need something like a central bank. And are you arguing that, these panic episodes were essentially symptomatic to other things? I mean, businesses fail in a crisis. That's kind of just a natural thing of what happens during a recession, and that this desire for a lender of last resort facility together with a fractional reserve banking system is kind of misguided. I mean, is this kind of fair characterization?
The facts you cite are correct.
I'm very happy to hear that.
But the nature of the fluctuations, Friedman and Schwartz document this very nicely in their monetary history. You'd see the money supply, they called it M2, which is checking plus savings deposits at commercial banks, would go down maybe 10%. And a little bit later, a few months, output would go down 10%. And they would suspend convertibility with the ways you described. They figured out ways to carry out the transactions in these towns where the banks were shut down to get around this. The economy's output in the money supply came back up, and it was history within 6 months. Currently, our depression, we're depressed about 10 or 12% relative to pre-2008 trend on a per capita income basis. And this has been for 6 or 7 years. In the Great Depression, it lasted for 10 years, and it was 25%. So, but now we're better at getting around these things. The mortgage markets went out of existence virtually in 1981 when they had these very high interest rates. Remember 18% interest?
Oh, yeah, I remember that.
That's where you worried about made the payment at the last
That was
minute.
the year I lost my job in the construction sector in Vancouver and decided to go back to university.
Yeah. But that year I moved from Carnegie Mellon to the University of Minnesota. I had to sell a house in Pittsburgh and buy one in Minneapolis. It was not through the banks. It was done. I issued a mortgage to sell, and the people that we bought through provided financing. Once the things got settled down a couple of years later, went through the regular the banking system for the mortgage. You diversify risk better that way.
But I mean, am I understanding you correctly here? Maybe I'm not. I mean, it sounds almost like you're suggesting that this fractional reserve banking system really didn't do much in terms of creating the downturn or propagating the downturn. And if not, then if that's the case, then why this radical proposal to impose 100% reserve banking? I mean, is it solving a problem that doesn't even exist, or?
There's a famous Rahm Emanuel said, don't waste a crisis.
Yeah.
When there's a crisis, government uses that as an excuse to do things. And they use this one little financial disruption to put in a lot of policies that depressed real output, depressed productivity. And
you're suggesting that they should have used this crisis as an opportunity to pass kind of a radical banking reform?
sometimes Scandinavia banks all went bankrupt in 1992. They instituted good reforms, and they did great afterwards. So they did not waste that. Japan had a crisis at the same time. They did not.
Right.
They lost a decade of growth. That's 18%.
I guess what I'm asking is, do you see a large welfare cost associated with the, I mean, it's true, you know, in the recent crisis, actually, the banking crisis was not centered in the retail sector. I mean, we have FDIC, the Fed's there.
The Fed did a good job.
Yeah, thank you. It wasn't me, but personally. But, you know, retail level bank runs in the United States have been a thing of the past since about 1933. Are you specifically thinking more kind of shadow banking sector reforms here in this paper?
I don't want a financial crisis and give people excuses. When I see policy, I think people should get together and examine and think long run, not the next 6 minutes, a day to worry about. We want a good set of rules to follow that facilitate an efficient payment and credit system that's sound. That's valuable. And I think with the new technologies, it's going to change, and we want to have a good one, a better one instituted. Our financial systems have been getting better.
I guess there's kind of two dimensions to the financial system, the banking sector, and at least I should say. I mean, one is the payment system. And I think you're absolutely correct. There's been rapid technological change in this space that's permitting more efficient, more secure payments. And we've also seen this kind of really wild kind of innovations out there in the cryptocurrency space, Bitcoin, the blockchain, the potential applications. So there's that element. But I mean, apart from facilitating payments through the banking system, I mean, banks also perform other functions. Maturity transformation, I guess, is a classic one. The Diamond and Dybvig model is a classic formalization of this notion that banks, actually perform a socially useful role, but they are nevertheless, that requires fractional reserve structure, kind of the issuance of highly liquid demandable liabilities, that if everybody exercises the redemption option simultaneously, there's just not enough reserves in the system. You end up in fire sales, and the payment system disrupts, et cetera. So there's that side to it. So I'm trying to figure out where you're coming from here, where you see this paper fitting in and contributing. Is it on the kind of the payment side? Let's take seriously, the new technologies that are there. Let's permit, everybody to have an account either directly or indirectly with the Federal Reserve, an interest-bearing account. Or do you see this prescription more dealing with kind of the ills that you see with fractional reserve banking systems?
The transaction part of the financial system is the small part.
Okay.
The major function of the financial system is a place to channel our savings for retirement into productive assets and not use up a lot of resources in the process, and let us diversify risk that averages out, idiosyncratic risk. And our system has got quite good in that regard. I'm worried about the transaction part, that little part, being the tail that wags the dog. And want to separate that out in a nice, simple, clean system. Commercial banks, only a small part of that is tied in with that transaction. Most of their assets under management are in trust, where people put up their money and they finance a project, and You take a little piece of a number of those projects and diversify. And there's also one diverse, so that system works very well. They have the information within the bank. It just seems, but there's a time inconsistency problem of policy.
Oh.
If it seems that governments, if there's a financial failure, bail out the lenders. And who ends up paying for that?
The Chinese.
Junior must pay.
The Chinese, of course.
Well, we get a lot of money from abroad. They lend us I talked to the former prime minister once. This is 2005 in this thing, and I said, everybody was yelling about them holding all this. If you want to make it cheap for me to borrow, I don't mind.
Exactly.
We get a lot. We lend a lot of abroad. Some people estimate half our national debt of about a GNP, which is an annual GNP, which is a big number, is held by foreigners, and but the Chinese economy is getting too big because they've been having these foreign reserves, which are mostly U.S. dollars.
U.S. Treasury, sure.
That they hold, and what else can they hold?
Exactly. New York real estate, maybe, but
they're starting to buy up.
But in terms of the moral hazard issue that you raised, I think that's true, but it's probably not specific to banking per se. I mean, there is a tendency for special interests to ask for the handout.
The corn farmers.
The corn farmers, yeah. So
too many to fail.
One thing that's true under 100% reserve banking is that there would likely be no need for Fdic, for example.
Yeah, that would save a lot of
deposits
money.
would be 100% insured, and this is including, I guess, very large deposits. Firms managing their cash flow, $500 million deposit overnight, it would be safe, I guess. There's no need to bail out.
There'd be no need. Whenever there's a transaction, somebody gets credited.
Yes.
When somebody gets debited, and you can, before the exchange, you can make sure that person has those deposits.
Yeah. So it's an attractive idea that way, and like I said, and like there's a long history of promoting this idea. Now I want to spend just a little bit of time to talk about the formalism that you used in your talk. I mean, you developed a mathematical model to kind of introduce this issue of evaluating, I guess, the costs and benefits of a 100% reserve banking system, a narrow banking system. What was the purpose of formalizing it in this way? I know it's subtitled an exploration. You're just starting out here, but what's the idea?
To begin to develop better intuition as to whether inflation rate targeting is good. Mm-hmm. All the central banks seem to have gone to the 2% target.
Yes.
All the big ones.
Mm-hmm.
Or should we focus on inflation rate or interest rate? There's debate, and does this make sense? But we want to have each of our sectors be more efficient, and this is just one sector in the economy, and we should stick.
Well, I mean, one sector that kind of interlinks several sectors in the sense that it performs the bookkeeping, and a lot of people have argued it's a very important sector. But I guess another way to phrase my question is, there's already a large body of models out there that attempt to address these types of issues. Maybe there's something you find unsatisfactory about the existing body of research, or did you just want to explore a slightly different tact? Or
the tradition was to focus on the traditional the banks that would take deposits and lend to businesses.
Yeah.
But the major sources of where people put their savings was there, or insurance company, whole life insurance, which were really a pension plus life insurance, and state and local government debt. That was pre-Federal Reserve period.
Yeah.
and people would hold that debt to maturity, and it's the government, state and local. But now things have gotten more complicated. And the system works quite well. It can do so much. Things get pooled and averaged out. There's a lot. When I issued a mortgage, I was nervous. It's a lot of risk. I could lose a lot if some misfortune fell on that family.
Are you suggesting?
But if you do this over a large number,
Yeah.
they average out.
Sure.
The fraction.
Well, those elements of risk sharing are there in some older models as well. But I mean, are you suggesting things have kind of changed in a manner technology has progressed where we kind of, it's worthwhile to leave that older class of models and explore different avenues?
Well, mutual funds used to be
A tiny.
a couple percent
And now they're
a year.
huge, right? Yeah.
Now they're talking about 1/50th of that, the amount that's gotten so much more efficient there, and then that works better. The financial system has been getting better, and the spread between borrowing and lending rates have come down. We as a household like to borrow at a low interest rate, and we like to lend at a high. But that spread between those two has shrunk since the 60s.
It's arguably a good thing for sure. Yeah, the younger folks don't remember those days. we do though. But you use your model to well. Actually, before I ask this, every person who studies this question of banking design, monetary policy, the way you do here, has to address the question of how the monetary policy and fiscal policy kind of interact. I mean, do you have a view about, I mean, does it even make sense to speak of monetary policy without at least, being kind of explicit about what's happening on the fiscal side? I mean, what's your view on that?
Within a range you can, but Venezuela and Argentina are not in that range.
Okay.
There are lots of countries have high inflation. Russia, Iran, Brazil, 10%. In those other countries, 20%.
These are fiscal phenomena.
And that's fiscal.
Right.
It's really a fiscal theory of the price level. It comes down to if you start using the monetary system to quote the inflation tax.
You don't think that's the case for the United States? I think maybe John Cochrane and others might argue otherwise. I mean, there is, this huge worldwide demand for U.S. Treasuries, and with the yield on U.S. Treasuries so low, they practically look like Federal Reserve liabilities.
We're almost borrowing at zero.
Yeah, but I mean, it's
not a bad deal.
Absolutely not a great deal. But the point is that these treasuries are issued not by the Fed; they're issued by the Treasury. It's not.
Yeah,
So
it is.
So this, what does it mean to conduct monetary policy without reference to what's happening on the fiscal side, even in the United States? Never mind
even
Venezuela.
in the United States. In this paper, I tried to keep it as pure monetary policy as possible. It was impossible.
It was impossible.
Because you got to have the government budget expenditures equal receipts.
I know that.
That's just a cash flow issue.
Yeah. It follows from the consolidated government's budget constraint, in other words.
Yes.
Yeah. In terms of, I know this is a preliminary investigation, very preliminary. You were very forthright about that, and just a paper to stimulate discussion. But nevertheless, when you were working on the model and performing some policy experiments, did you discover anything surprising in the model?
Well, one thing was satiating people with money. It's costless to produce almost. Mm-hmm. The Fed only pays for the printing cost and the transportation cost. Mm-hmm. The St. Louis Fed, for the currency they get. And given it's virtually costless to produce, facilitates the businesses, entering into contractual arrangements, you want to decentral some. You want to have independent accounts and in profit centers, and that changes how that organization is. They hold it, they do it for a reason. If you're a business, you want to have some reserves till you're ready.
Well,
for when an opportunity comes up.
The idea of satiating individuals or businesses with liquidity sounds very much like the Friedman proposition, the Friedman rule.
He proposed satiation. Right. He's the one that one of the first to propose it.
You just discovered it now? Is this what you're saying?
Well, the Friedman rule said to deflate at the rate of inflation, at the real return on capital.
Well, that was in the context of zero interest-bearing money.
And that was in the context of zero. That's why I want an interest-bearing currency. It was a big difference.
Well, I mean, you want to equate the rate of return of money with other safe assets, I guess. Is that
yeah, and keep it simple for people. And don't make businesses have to guess what the inflation or policy is going to be. And they have a good, so they can worry about producing more efficiently.
Right. Give them a nice, safe payment system. No need for federal deposit insurance.
There's lots of regulation. There's no new banks being created recently.
Interest-bearing accounts for individuals, either directly with the Fed or maybe an account through the
transaction intermediary.
You say that you spent a little bit of time discussing possible problems with this system. And one thing you said, before initiating the system, one would need to consider, among other things, privacy protection, shadow banking. And so what are your concerns here?
Currency can be pretty anonymous.
Right.
And privacy is important. We've got to protect that. It's a difficult thing to handle. Because some governments have been known to abuse that.
Sure.
Or some private agencies too, with their getting together and.
I mean, we've had all these data breaches and
data breaches are a key thing.
Personal information, and I guess we'd have to trust these institutions to keep all of this information secure. Something we don't have to worry about with cash or even with a lot of these cryptocurrencies.
Sometimes you have to worry about being stolen.
Yeah.
Somebody hitting you over the head.
Well, that's also true of Bitcoin. I mean, if you lose your, if you lose your computer, I mean, it's basically gone as well.
Oh.
So there's shadow banking. I guess, what can we do about shadow banking? I mean, it seems like, you know how clever bankers are. I mean, it seems like the whole shadow banking sector is kind of exists just to bypass existing regulations and
create a substitute for money, their usual money.
Oh, so do you actually a substitute?
That's what they did.
So do you think actually this type of proposal would
get part of the senior
eliminate shadow banking to some extent, or would it push more business toward shadow banking? You see it as a substitute.
There's the thing is they would try and get part of the. They would carry out the transaction with a little smaller spread between the interest rate in these worlds where there's just two interest rates, which there's not. There's all kinds of interest rates.
Sure.
And which one you're referring to is ambiguous, and a lot of resources are used up in that sector, that financial sector.
You know, but the kind of like the defining characteristic of banking, I would say, and shadow banking is the the coexist. It's the kind of mismatch between the asset and liability structure. In shadow banking, you have these very short-term liabilities, financing.
Yeah, it's these clearinghouses. The amount of transactions in dollar terms carried out in a day is something like $0.6 annual GNP.
Yes.
So I don't care how anywhere near that quantity of transactions, but they're doing lots of things are being. But some of these things in these clearinghouses, they did not get into trouble in the recent crisis, and it's a lot of this making the markets efficient and liquid, where when you buy and sell stocks, the spread has gone down virtually to zero. And there's our people in that business doing it. It's getting more. I think fewer people are doing it, but using more machines for fast trading.
Right.
I think that's been a progress, and some groups will get together and set up. The various members of those clearinghouses have to put a certain amount up in the day, and
Yeah.
but now they're working towards point-to-point clearing, so it isn't they put them all together and then add up all your transactions during the day if you're a member of that clearinghouse,
Right.
and just the net amount gets debited or credited.
You also have a slide here on a possible solution to the shadow banking problem, and one of your bullet points is intriguing. You suggest, here's a policy prescription from Ed Prescott, tax net interest income at 100% rate for limited liability businesses.
Yeah.
Think?
All households are really a household business, and I want to let them lend money and have positive interest and not have that taxed 100%. So the households are what are important. They really own things. All the assets, directly or indirectly, they own the firms that own the assets, or sometimes they own the firm that owns a firm that owns a firm that owns the assets and incurs the liabilities. I think we want to get rid of the gamblers.
Gamblers, yeah.
That
Well, I mean,
then
buying low and selling high. I mean, I wanted the crowd to understand this is profound. I mean, Ed Prescott is suggesting that a tax rate out there is too low, and that the appropriate tax rate is 100%.
Yeah, it's on a particular type of income.
Okay. Net interest income from these gamblers.
Yeah, and they got to be limited liability, so they can't stick
Right.
it on the taxpayers.
Right.
The lenders to them get bailed out by the taxpayers.
Oh, okay. Yeah, that would be interesting do you actually experiment with this these tax reforms in your model? Is this a bit too
policy? If it was, maybe they'd figure out something to get around it.
Yeah, who
That's
knows?
one of the reasons I put it on the table,
Right.
for smart people to come up with reasons why it won't work.
Well, Ed, I mean, this is great stuff. It was a lot of fun listening to you talk about banking and money. It was really a lot of fun. Just to conclude, if you had just a few takeaway points from this body of research, like what you've done today and where you'd like to see it go, what would you say in 2 or 3 bullet points?
Well, I'd like theory to advance to provide better guidance to the design of a better system, and there'll be some benefits to the people of having a better functioning payment system. It's not a huge thing, but add up a lot of these over, it starts getting important over different sectors. Good regulation is good. Bad regulation is bad.
I think that's something we'll all agree with. Thanks a lot, Ed.
Sure.
Appreciate your time
Say,
here.
David.
Thank you.
Enjoyed talking to you.
It's good.